at the global markets. Aussie futures heading up, the Dow ending the day down, but take a look at that gold. That is incredible that it shot through that $2,300 an ounce. We might talk more about that and get an understanding of what's going on with the gold price. For more on finance, we're joined by James Gerrard from the Financial Advisor website. James, good morning to you. Can we talk about house prices as well? Because you need a bucket load of gold to buy them these days, and there's suggestions that it might even be going up more.
That's right, Lisa. So Oxford Economics Australia is predicting that house prices in most capital cities of Australia are going to go up by 10 to 15% per year for the next 3 years. And that's higher than the long-term average growth rate of 7.5%. And so the reason for these forecasts is due to the economics of demand and supply. So on the supply side, we're seeing an ongoing shortage of new houses, despite the federal government wanting to increase the national housing stock. And on the demand side, we're seeing strong buying from new migrants and foreign buyers, and that's filling the void left by domestic buyers who are a bit shell-shocked at the moment with 13 interest rate increases over the past 2 years, with the average home loan rate going from around 2% to over 6% today. So based on all that, what we're seeing is that the house prices have been going up, and we're seeing record numbers of migration into Australia. Over 550,000 people have migrated to Australia, and that's pushed property prices higher, with Perth leading the way. They're up 18% for their house prices over the past 12 months. And the forecast for Sydney is for the average house price to be almost $2 million in 3 years' time. And even though 35,000 people have departed Sydney over the past 12 months, there's been over 150,000 people from overseas that have settled in Australia. So that's led to the Sydney property market increasing by 8% over the past 12 months. And that's likely to keep going up if interest rates come down later this year as predicted and local buyers come back into the market.
Yeah, James, extraordinary. Hey, we're apparently having to work longer as well. New research from KPMG.
That's right, Lisa. So these days, people are working an average 3 to 5 years longer before they're retiring. So that means that we're retiring in our mid-60s on average compared to our early 60s 20 years ago. And there's a couple of reasons for that. So the first is that there's been structural changes to our labour market, which means there's been less reliance on manual labour, which has enabled more people to continue working into later ages rather than have to retire due to health reasons. And we've also had other reasons why people have been able to work longer. There's been strong labour market conditions, and that's been supportive of older Australians working. And of course, after COVID and lockdowns, we've had more flexible working environments with people being able to work from home more, and that's encouraged people to work longer. And when it comes to retirement in general, there's a few different dates and ages which can be a little bit confusing. So previously, you could retire at age 55 and access your super, but that's now age 60. And the age that you can access your super while you're still working is 65, and that's different to the age that you can access the age pension from Centrelink, which is 67. And just coming back to people working longer, I think that we're seeing people work longer because if you retire at 60, on average, you're going to live another 30 years into retirement. So people are probably working longer so that they can build up a bigger nest egg and not potentially deplete all of their savings in their lifetime.
James, we preface all our conversations with letting our viewers know they should seek their own financial advice on all these matters, but we are getting into tax time. What have you got? Some tips for us to reduce tax?
Absolutely, Lisa. So it's still the same case. One of the biggest tax tips is to salary sacrifice into superannuation. When you put money into super, you're not paying up to 47% income tax. Your tax rate on that super contribution is 15% and up to 30% if you're a higher income earner earning over $250,000. So for this financial year, the cap is $27,500, and you need to remember that includes both your employer contributions plus your salary sacrifice. So when you're trying to work out how much extra you want to put into super, you need to take into account that employer contribution. And as an extra tip, for people who have less than $500,000 in super, and if they haven't maximised their super over the past 5 financial years, they can go to the ATO portal inside of MyGov and see how much they can catch up and make a lump sum super contribution pre-tax. And that's really helpful for people who have big taxable events such as selling an investment property or selling a share portfolio. They can make that catch-up contribution to reduce tax. But Lisa, as you said, this is all general information and people should seek professional advice before they implement any contribution strategy.
We always love your contributions, though, James Gerrard. Thanks for coming on.
Thank you, Lisa.
A 21-year-old man will appear in the